You know that exact moment when your trade closes in red, something inside you just snaps. You will not let this stand. You are going to get that money back right now, this minute. And that single decision is the moment the real damage begins. Let me show you exactly what happens next, step by step. Austin woke up at 7 a.m. Coffee made, charts opened, setup identified. Euro dollar 4-hour chart. Clean structure, a bearish setup at resistance. He placed the trade with full discipline. Stop loss set, risk to reward 1 to 3. He calculated 1% account risk, $50 maximum on a 5,000 account. The trade was structured and planned, exactly the way trading is supposed to work. For 40 minutes, the position moved in his direction. He felt calm, in control. Then price reversed sharply. A news release he had not checked hit the market. MetaTrader notification. Trade closed. Red. Minus $50. Planned risk was hit. A $50 loss on a 5,000 account is 1%. Perfectly acceptable in trading. But that is not what Austin felt in that moment. Not even close. What he felt was the amygdala firing, the threat response, the survival instinct activating. His brain did not see a planned 1% loss. It saw a threat to neutralize. Cortisol flooded his system. Tunnel vision. One thought repeated. Recover. 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 This is not weakness. This is biology. Every human brain is wired exactly this way. The prefrontal cortex, the rational brain, begins going offline under chemical pressure. Decisions that take 20 minutes of analysis now take 3 seconds. That is the danger. Austin opened a new trade. No setup, no structure, just a direction and a button. He increased the lot size, not 0.05 lots like before. Now, 0.15 lots. 3 times the risk. If this trade wins, he recovers the loss immediately. Simple math. This logic feels completely rational. That is the most dangerous part of revenge trading. The second trade hit his stop loss 18 minutes later. Now down $150 total. A $50 loss became $150 in 18 minutes. The math has changed completely now. Cortisol is not going down, it is going up. The pressure to recover keeps increasing. Austin opened trade 3, now 0.30 lots. 6 times his original planned risk on the account. He has not checked structure, he has not drawn levels. Only raw price movement matters now. This is no longer analysis. This is a coin flip with 6 times the borrowed stakes. Trade 3 closed red, down $300. Account dropped from 5,000 to 4,700 in 1 hour. Pattern interrupt. 73% of accounts blown in a single session started with one planned loss. One structured, disciplined loss triggered the sequence that ended the account. Not bad trading. Austin now believes the market owes him money. This belief is the engine of destruction. The market does not owe Austin anything. It has no memory of his previous trade at all. The market does not know he lost. It does not care. Price moves, that is all. Austin is now operating on a completely different set of rules than the market is. He thinks, I was right about direction. The news ruined it. I deserve to win. This sense of deserving is catastrophic in a market that has no concept of justice. Trade 4. Austin opened 0.50 lots, 10 times his original risk on the 5,000 account. His stop loss is now so tight he is practically asking the market to take it. Subconsciously, he cannot afford a large stop. He needs this entry to be perfect. But he has done zero analysis to find a perfect entry. He is guessing with a tight stop. Trade 4 closes red. Account now at 4,400, down $600 in under 90 minutes total. The tilt spiral has fully begun. Lot size is increasing, analysis decreasing, speed of trades increasing. This pattern has a name in behavioral finance, the escalation of commitment. The more you invest in a bad direction, the harder it psychologically becomes to stop. Each new trade is not just recovering money, it is also justifying every previous trade placed. Stopping now would mean admitting everything since trade 1 was a mistake. Austin cannot do that. So Austin opens trade 5. The logic of tilt has taken almost complete control of decisions. Pattern interrupt. A survey of 1,200 traders found the average blown account involved 4.7 revenge trades. The sequence has a predictable structure. It never ends at trade 2 or 3. It escalates. And the reason it escalates is deeply neurological, not a matter of discipline or willpower at all. When the brain enters recovery state, dopamine release becomes directly tied to the trade outcome. Each new trade feels like the solution. The act of opening the trade generates anticipation dopamine. This is the same neurological mechanism that keeps a gambler at a slot machine for 6 hours. Not stupidity, not weakness. A hijacked reward circuit operating on broken feedback loops. Trade 5 wins, plus $180. The relief is enormous. Austin feels his shoulders drop completely. He is still down $420 from session start, but the win felt like a full recovery. This is intermittent reinforcement, the most powerful conditioning mechanism in all of psychology. A win inside the revenge sequence does not stop the session. It intensifies the very next trade. Now Austin believes, hold on long enough and the market always gives the money back, eventually. This belief is lethal, statistically false in a revenge context, but it feels completely and totally true. Pattern interrupt. Accounts with a mid-session win during a losing run lost 34% more by day end. The mid-session win made the final outcome worse, not better. It reinforced the revenge trading behavior. Austin now opens trade 6. He feels encouraged. He is certain the plan is clearly working now. Lot size, 0.80 lots, 16 times his original risk per trade. Account still sitting at only 4,580. Trade 6 closes red. Account at 3,780. Down $1,220 in one single morning trading session. He has now lost more this session than his planned maximum monthly drawdown in one morning. Before we continue, one mention about where I document all of this in real time. At FX Austin on Telegram, I share every trade I take, including the losses and the stops that hit. What real accountability looks like in practice. Not a highlight reel, the full trading record. It is free. Link is in the description below. Come and see what structured trading actually looks like. Back to Austin, trade 7 is open. 1.20 lots. His coffee has gone completely cold. He has not noticed the cold coffee. He has not noticed that 90 minutes have passed. Time distortion is a documented symptom of tilt. The session feels like 15 minutes to him. Trade 7 closes red. Account now at 3,120, down $1,880 in a single morning session. Austin opens trade 8 immediately. No pause, no breath. Just the next position opening. Lot size, 1.50 lots. 30 times his original planned risk from the beginning of this session. Here is what the recovery math actually looks like at this point in the session. To recover $1,880 with 1% risk, Austin needs 37.6 consecutive winning trades. But Austin is not risking 1% anymore. He is risking 30 times that per trade now. He thinks, one big winning trade solves everything. The math does not support this thought. Pattern interrupt. To recover a 50% loss, you need a 100% gain. Not 50, 100. If the account drops to 2,500 from 5,000, recovering requires doubling what remains. Most never do. Every time Austin doubles the lot size, he doubles the potential damage of the next losing trade. He thinks he is accelerating recovery. He is accelerating the path to zero. These are opposite directions. Trade 8 closes red. Account at 2,820, down $2,180. Only 56% of the account remains. Austin now needs a 79% return on remaining capital just to return to where he started this morning. He does not think about that math. He thinks about the next trade, the one that fixes everything. This is the 5 stages of revenge trading. Every trader who has experienced tilt knows these stages well. Stage 1, the trigger loss. A real, valid, planned loss that simply hit the stop loss correctly. Stage 2, the first revenge trade. Bigger size, no setup. The logic feels completely sound at the time. Stage 3, the spiral. Multiple losses stacking. Lot sizes doubling. Analysis completely gone from the process. Stage 4, The false win. A mid-session winner that feels like recovery but intensifies the entire session. Stage 5, the terminal phase. Account down 40 to 80%. One trade left to fix everything. Austin is in stage 5. Trade 9, 2.00 lots. His account has $2,820 left to work with. He has found a new setup, or what his cortisol-flooded brain believes is a setup on the chart. The trading view chart shows euro-dollar consolidating near a level. This could be a breakout setup. In his normal state, Austin would spend 30 minutes evaluating context, structure, and momentum carefully. In his current tilt state, Austin evaluated this in 4 seconds. He saw a number and a direction. Pattern interrupt. In tilt state, trading decision time averages 6 seconds. Normal state, 18 minutes average. The brain under cortisol and dopamine flooding does not have access to its full analytical pattern recognition. It sees what it wants to see. It finds the setup it needs to find to justify the next trade entry. This is called confirmation bias under emotional loading. The brain cherry-picks data to support its trade. Professionals call this trading from the P&L rather than from the chart. It never ends well for anyone. Trading from the P&L means your entries are driven by account balance emotion, not market structure at all. Under tilt, the trader will find a reason to enter in the needed direction regardless of what the chart shows. Trade 9 is placed, 2.00 lots. Austin is all in mentally. This is the trade that fixes everything today. For 3 minutes, price moves in his direction. Austin feels the tension in his shoulders release slightly. Then price reverses sharply. Again. The market does not care about Austin or his preceding losing trades. Stop loss hit. Account now at $2,120, down $2,880 from the session open of $5,000 this morning. Austin stares at the MetaTrader balance. $2,120 remaining. 42% of what he started with today. Pattern interrupt. The average revenge trading session lasts 2.3 hours and involves 7.2 trades total. Austin is at trade 9, approximately 100 minutes into the session, almost exactly statistically average. He is not an outlier. He is executing the statistically average revenge trading sequence with precision. Now let me show you what professional traders do differently. And I mean structurally, not just mentally. Professional traders do not rely on willpower to stop revenge trading. Willpower fails completely under cortisol. They use structural prevention, systems and rules that remove the decision entirely. No choice left to make. The first structural tool is the daily loss limit. A hard number defined before the session even starts. For Austin, with a 5,000 account, a 3% daily loss limit equals $150 maximum loss per session. When the account hits that number, the trading session ends. No more trades today. The platform locks. Many professional firms use automated daily loss limits enforced at the platform level by the system itself. Austin did not have a daily loss limit defined. He had trade level stops, not a session level stop. A trade level stop protects each individual trade. A session stop protects the entire account from the tilt spiral. These are completely different protection layers. You need both. One without the other leaves you exposed. Pattern interrupt. Funded traders with daily loss limits blow accounts at 4% of the rate of those without. Same trader, same strategy, same market. The only difference? A session level loss limit rule in place. The second structural tool is the kill switch, a pre-written rule that triggers after a defined loss event. Austin would write this rule before the session. If I lose 2 trades in a row, I close the trading platform. Not pause, not take a break. Close the platform completely. Walk away from the desk for 2 hours minimum. The kill switch must be written before the session starts. During tilt, you cannot write an effective kill switch because during tilt, the brain will not agree to any rule that stops the recovery from happening right now. The rational brain writes kill switches. The tilt brain ignores them, redefines them, finds the exception to the rule. The kill switch must be written when calm, signed with a date, and placed physically at the trading desk. Third structural tool, the cooling protocol. After a losing trade, a defined waiting period before the next entry. Austin would set this rule. Minimum 30 minutes between any trades during a losing trading session. Not because 30 minutes solves the psychology completely, because cortisol has a half-life of approximately 30 minutes. After 30 minutes, the chemical pressure that drives revenge trading has dropped by approximately half its peak level. This does not guarantee a good next trade, but it guarantees a less cortisol-impaired decision-making process. Before we continue, one final mention for this section of the video. At FX Austin on Telegram, I document what structured trading looks like in practice over weeks and months of time. The losing trades, the sessions where I triggered the kill switch and walked away from the desk entirely. If you want to see what applying these structural tools actually looks like in a live trading account, come see. Austin did not have any of these 3 structural tools in place during this session today. And that is not a personal failure. It is the default state of almost every retail trader globally right now, because nobody teaches this. Brokers do not teach this. Strategy courses do not teach this. But now, you know. Trade 10. Austin opens with everything he has left. 2.50 lots on a $2,120 account. This is not trading anymore. This is desperation disguised as strategy. The last bet. The position opens. For 8 seconds, price holds. Then it moves against him immediately. MetaTrader shows the position value dropping in real time, the account dropping live on screen. Austin watches the balance hit 1,400, then 900, then 450. The margin call is coming. MetaTrader shows Mario call. Positions are being closed automatically by the broker now. Account balance, $180. $5,000 entered this session 3 hours ago. The fan in his computer. The blue LED keyboard glow. The silent desk. That is all that remains. Austin sits at the desk and stares at the MetaTrader balance. $180. He cannot move. This is the end of the revenge trading sequence. Stage 5 executed to completion. Account gone. What happened in the 4 seconds after the first loss determined the outcome of the entire morning. Not the market, not bad luck, not the news release. The 4 seconds after the planned loss hit. The decision to open the second trade was the entire event. Everything after it was the consequence. Pattern interrupt. Only 11% of traders who lose 50% or more in a single session return to their peak balance in that account. The psychological damage of a full account blow is compounding. It does not reset when you reload funds. What gets damaged? The belief system, the confidence level, the relationship with loss itself. Traders who blow accounts often return with new capital and execute the same revenge sequence again because the structural system was never built. The root cause was never addressed. Only the balance was. This is what I want you to understand above everything else in this video today. Revenge trading is not caused by not knowing it is bad. You already knew that before today.
The cause is absence of structural tools.
It is caused by the absence of structural tools that prevent the behavior from being possible in the moment. You cannot outthink cortisol. You cannot discipline your way through a dopamine hijack. Nobody can do that. What you can do is build an environment where the behavior has no structural possibility of occurring at all. Now let me show you what Austin looks like 3 months later with all 3 structural tools in place. Austin wakes up, makes coffee, opens the platform, checks the written rules on the desk. Session begins. Daily loss limit, confirmed. Kill switch conditions, confirmed. Cooling protocol, confirmed. He is ready. He takes a trade, euro-dollar, 0.05 lots. Stop loss placed. Risk to reward 1 to 3. Clean, valid setup. The trade hits the stop loss, minus $50. Austin checks the written kill switch rule on the desk. 1 loss. Kill switch rule says 2 consecutive losses before trigger. This is loss 1. Session continues. Austin waits 30 minutes before evaluating the next trade. The cooling protocol is running as designed. After 30 minutes, he looks at the chart. The cortisol has dropped. The analysis feels clearer now. He does not see a valid setup. He closes the platform. Loss, $50. Session done. He walks away. The urge to trade more is present. It is still there. But the written rule does not permit it today. This is what structural trading looks like in practice. Not excitement, controlled process, Clean
not the
exits.
excitement.
The next day, Austin takes 2 losses in a row. Kill switch triggers. Platform closes. Session ends. Total loss for that day? $100. 2% of account. Within the defined daily loss limit, Austin walks away from the desk, frustrated. But the account is intact. The system did its job. The structural system did exactly what it was designed to do. Nothing more, nothing less. That is the goal. Pattern interrupt. Traders with all 3 structural tools maintained for 60 days show 3.1 times more account longevity. Not better win rate, not better strategy. Longer account survival, which is the prerequisite for everything else. Because you cannot improve a system you blow up in a single revenge session before you can analyze it. Now let me give you the implementation checklist. 5 actions to take before your next trading session. Action 1. Define your daily loss limit in exact dollar terms. Write it down, sign it, date it today. Action 2. Write your kill switch rule. Exactly how many consecutive losses trigger it. Write it now. Action 3. Write your cooling protocol. Exactly how many minutes between trades in a losing session. Action 4. Place all 3 written rules physically at your trading desk where you will see them. Action 5. Tell someone. A trading partner, a community, a journal. Make the commitment public. Making the commitment public activates a psychological mechanism called public commitment consistency. You are significantly more likely to follow a rule you have told someone else about. Use this mechanism. Pattern interrupt. Traders and peer accountability groups maintain structural rules at twice the rate of solo traders. The isolation of retail trading is itself a risk factor. Accountability is not a luxury. It is a structural tool. Now let me address the final question that will come up when you try to implement this system today. The question is, what if I miss a big trade because I triggered the kill switch too early in the session? The answer is, you have assumed that missing a trade is worse than blowing the account. It is not. A missed trade has 0 cost. A revenge trading session has the cost you watched Austin pay this morning. Every trade you do not take from tilt is a trade that did not damage your account or your psychology. The kill switch does not make you miss trades. It makes you miss revenge trades. These are different things. Before I close, one final mention about where I put all of this into practice in real time. At FX Austin on Telegram, I share the trading record, including the days where the kill switch triggered, the sessions that ended early, the days I walked away at a $100 loss and watched the market move. That documentation is the point, not the winning trades. The accountability of the structural system apply. Link is in the description. It is free. Come and see what this looks like over weeks and months of trading. Let me close with the full picture of what revenge trading actually costs beyond today. Not just the $4,820 Austin lost in one 3-hour session this morning. The compounding cost of revenge trading over 12 months is what destroys most trading careers entirely. One 80% drawdown session resets months of disciplined, profitable trading in a single morning. The average retail trader experiences 2.3 revenge trading episodes per month, each costing more than the last. Over 12 months, those episodes account for more than 70% of annual account losses on average. Not losing trades, not bad strategy, not bad markets. Revenge trading is the primary loss mechanism. The structural system is not a nice to have. It is the highest leverage change available to most retail traders. Austin, 3 months later, with the structural system in place, is still trading. Account intact. System running. The urge to revenge trade after a loss is still present. It will always be present. It never disappears. But there is no structural moment where the urge can become an action. The system closes that moment. Build the system before the next loss. Because after the next loss, it is already too late to build it.